Welcome back to the Deep Dive. Today we are taking an exhaustive look into one of the most tempting and definitely one of the most complex financial crimes on the planet, insider trading.
It really is. It's the ultimate shortcut, isn't it? And it's been the subject of regulatory anxiety for, well, almost a century now. At its heart, we are talking about buying or selling a company's stock or its securities based on material, non-public information.
And that right there, that phrase, material non-public information, is key. It's information that, if the rest of the market knew it, would almost certainly cause a significant shift in the price.
Exactly. And that simple definition, it opens up this huge legal and ethical fissure.
Right. Is this just a clever, maybe even harmless way to profit on having superior information? Or is it fundamentally unfair? Is it fraudulent and maybe even a threat to the integrity of the entire financial system?
Well, legally, most every jurisdiction around the world has sided with that latter view. But, and this is what makes it so fascinating, the rules defining why it's illegal, and more importantly, who counts as an insider, are constantly being rewritten. The courts are always trying to keep pace with sophisticated bad actors.
So our mission today is to go a lot deeper than the typical headlines.
That's the plan. We're going to explore the complex legal frameworks worldwide. We'll dissect the fundamental arguments both for and against its prohibition.
And yes, we'll actually spend time with the Nobel laureate arguments for outright legalization, which is a mind-bending idea for most people.
It is, and we'll examine how the definition of an insider has just expanded dramatically through these landmark U.S. court decisions. It's not just the CEO anymore. Now it can catch the proofreader, the consultant, even the politician.
Okay, so let's start there. Let's unpack the two primary reasons for prohibiting this practice. Because fundamentally, it feels like we have a philosophical battle between market fairness on one side and corporate duty on the other.
That's the perfect way to frame it. That's the tension. So the first rationale is what you could call the market integrity argument.
Okay.
Regulators argue that allowing insider trading makes the entire system look rigged. And that's, profoundly unfair to the average investor.
The person putting money in their 401k.
Exactly that person. If an executive knows the stock price is about to double because of a confidential product announcement, and they buy a ton of shares before anyone else can, their ability to make these massive disproportionate profits just destroys the necessary level playing field.
And if the public loses faith that the game is fair, they pull their capital out. And that, of course, hurts everyone.
It does. Then the second pillar, as you said, seems to relate less to the market as a whole and more to the internal rules of a company. It's all about corporate governance and fiduciary duty.
Right. So this is about the promises an executive makes to the company and its owners.
Precisely. It's prohibited to prevent key personnel, your officers, your directors, from abusing confidential corporate information for their own personal gain. They are deemed to be agents of the shareholders, and because of that, they owe a fiduciary duty of loyalty and trust to those shareholders.
So using corporate secrets to line their own pockets is a direct violation of that trust.
It's essentially theft. It's theft of a corporate opportunity.
What's really fascinating here, though, is the academic paradox that this whole prohibition creates. We know regulators catch the big, high-profile cases, but a lot of studies suggest the majority of illegal insider trading just slips through the cracks.
That's where the academic debate gets truly provocative. Scholars point out that since the vast majority of illegal insider trading is probably never detected by law enforcement, the very existence of the prohibition gives the public a potentially misleading impression that stock market trading is an unrigged game. They argue that this false sense of security might actually be more detrimental than simply legalizing it and acknowledging that, look, asymmetric information is always at play in markets.
So the prohibition itself could be seen as a sort of necessary fiction, a psychological tool to maintain public participation and trust, even if it's, in reality, very unevenly enforced.
Exactly. And this tension, the difficult proof, the argument over who is actually harmed, this is why the U.S. legal system in particular has seen decades of highly complex litigation as it tries to nail down what constitutes the necessary fraud required to prosecute these cases.
Okay, let's turn to our first section then. The legal cornerstones defining the insider and the crime. We need to start with the people who are, transparently monitored and who have the clearest possible legal duty.
This is the formal definition of an official insider. It's used globally for mandatory reporting. So in the US, Canada, Australia, Germany, and Romania, this group includes a company's officers, its directors, and any beneficial owners who hold more than 10% of a class of the company's equity securities.
These are the people who, by law, are just presumed to have constant access to material non-public information.
Correct. And their actions are under intense scrutiny because, as we mentioned, they have volunteered to assume that crucial fiduciary obligation. They have to act in the best interest of the shareholders above their own personal interests.
The analogy here is pretty clear. They're like trustees of the corporation's confidential information.
Absolutely. Let's use the classic textbook example. The CEO learns, maybe in a confidential board meeting, that a massive all-cash takeover offer is imminent. The public price is about to jump 40%. If that CEO then calls their broker and buys $1 million of stock before the public announcement, knowing the price will skyrocket, that is the clearest, most unambiguous violation of their fiduciary duty to the shareholders. They are, in effect, stealing value directly from the corporation.
Now, it's really important to clarify for you, the listener, that trading by these official insiders isn't automatically a crime. In fact, it's common and totally legal for employees, officers, and directors to hold and trade stock. They often get it through options or compensation plans.
Right.
So what's the dividing line? What keeps these routine trades on the right side of the law?
The dividing line is actually quite simple. They must not rely on material non-public information. If I'm a director and I sell 5,000 shares to pay for my child's college tuition, and I don't possess any confidential information about the company that would affect the share price, that's perfectly fine.
But there's a transparency requirement, isn't there?
Oh, absolutely. Crucially, these trades must be transparent. In the U.S., insiders have to file what's called a Form 4 with the Securities and Exchange Commission, the SEC. And that has to be done generally within 2 business days, and it details the transaction.
So that public disclosure is the key. It differentiates legitimate portfolio management from something that looks suspicious, like pre-knowledge trading.
Exactly.
Public disclosure requirement is obviously critical for maintaining market confidence. But why does the enforcement apparatus, the SEC, the Department of Justice, commit so many resources to this? I mean, does insider trading really have a negative macroeconomic effect?
It absolutely does, and this is a point that is so often missed when we just focus on the scandal of one person getting rich. The critical finding from serious academic study is that illegal insider trading raises the cost of capital for securities issuers.
Okay, that sounds a bit dense. What does that actually mean in real terms?
Think of it this way. If you, as an investor, perceive the market to be fundamentally unfair, if you constantly suspect that the deck is stacked because insiders are just skimming off the top, you're going to demand a higher return to compensate you for that hidden risk.
I see. So I want more potential reward because I feel like I'm taking on more unseen risk.
Precisely. And that premium demanded by investors, which gets built into the stock price, is the higher cost of capital for the company. The company then has less money to invest in expansion, in R&D, and hiring.
So while insider trading seems like this sort of private crime between a buyer and a seller, the ripple effect is actually a brake on overall economic growth.
That reframes the whole argument, doesn't it? It's
Right.
not just about fairness. It's about economic efficiency being actively harmed by a lack of trust.
Exactly. When markets are perceived as fair, capital flows more freely and cheaply. When they're seen as rife with illegal activity, capital becomes more expensive, and that slows down the whole engine of innovation.
So if regulators are trying to protect this efficiency, how do they actually prove the crime? I mean, given that traders can use really sophisticated tactics, nominees, offshore companies, it must be an absolute nightmare to link the information possessed to the trade that was executed.
It is notoriously difficult, which is why enforcement agencies rely so heavily on advanced surveillance technology. The SEC and the stock exchanges, they use these sophisticated data algorithms to actively monitor trading patterns for anything suspicious.
What would be a red flag for them?
Well, if they see an unusually large volume of trading, particularly in options, immediately preceding a major corporate event like a takeover announcement, that immediately triggers an investigation.
And then they have to follow the trail.
Then they have to follow the trail of money and communication. We're talking phone records, encrypted messages, email exchanges, anything to connect the trader back to the original source of the confidential information.
And the moment they catch a violator, what's the primary civil mechanism the SEC uses to strip away the incentive for this crime? It's all about incentive.
Right. The key financial mechanism is called disgorgement.
Disgorgement.
This is the forced repayment of any ill-gotten gains, or, and this is important, the repayment of losses avoided that resulted from the violation of securities laws.
So the philosophy is simple. You cannot profit from your crime. The SEC wants to return the violator to the financial position they would have been in if the illegal trade had just never happened.
And when they recover these funds, where does the money go?
When it's feasible, the disgorged funds are returned directly to the investors who were injured by the scheme. And while disgorgement is the core civil penalty, the penalties can be dramatically increased, especially in the U.S.
How so?
Well, acts like the Insider Trading Sanctions Act of 1984 allow the government to seek penalties of up to 3 times the amount of the profit gained or loss avoided.
A triple penalty. That's
Yeah.
a pretty strong deterrent.
It's meant to be. And while the SEC handles the civil side of things, if the case involves intentional, really egregious fraud, they'll refer it to the U.S. Department of Justice for a parallel criminal prosecution, which can, and often does, result in lengthy prison sentences.
So we've established the clear rule. If you are a corporate officer, you owe a duty to the shareholder, and violating that duty is the textbook crime. But of course, the smartest bad actors quickly realized they could just leak the information to someone else or steal it entirely without being an official officer.
That's exactly right. Which brings us to how the law had to evolve to catch those people. The legal frameworks had to dramatically expand because the crime started migrating outside the confines of the boardroom.
So the courts realized they needed to stop focusing only on the fiduciary duty owed to shareholders.
And start looking at the duty owed to the information itself.
This moves us right into Section 2, expanding liability to fees, misappropriation, and duty. And when we talk about illegal insider trading now, the term insider is, as you said, no longer limited to just the CEO and the board.
Not at all. It includes virtually anyone who trades shares based on material, non-public information in violation of some duty of trust or confidentiality. And this expansion started first with the people who receive the information secondhand, the tippies.
Okay, so if an insider tips a friend, how does that friend, who owes no direct duty to the corporation, how do they become criminally liable?
Their liability is established through what's called the Tippy Doctrine, which was largely defined by the seminal Supreme Court case, Dirks v. Securities and Exchange Commission, back in 1984.
And what did that case establish?
The court established a critical and often very confusing two-pronged test. A tippy is liable only if they knew or should have known that the tipper, the insider, breached a fiduciary duty.
Okay, that's prong one.
And the tipper did so for an improper purpose.
An improper purpose. So it wasn't enough just to have the inside information or even to know it came from an insider. The court had to look into the mind of the person giving the tip and figure out their motive. What does that improper purpose or personal benefit truly mean?
This is the subjective, really complex part of the law. The personal benefit does not have to be pecuniary. It doesn't have to be cash. It could be an intangible benefit, like boosting one's reputation or making some kind of quid pro quo exchange. The Dirks case itself is the perfect illustration of why the intent matters so much.
So walk us through Dirks. Why was he found not guilty in the end?
Okay, so Raymond Dirks was a securities analyst. He received confidential information from a former officer of a corporation about a massive, ongoing fraud within that company. Dirks then investigated, he confirmed the information, and he shared it with his clients, who then sold their holdings before the stock completely collapsed.
And the SEC prosecuted him for that.
They did, but the Supreme Court ultimately ruled that the original insider's motive was to expose fraud. It was to be a whistleblower, not to gain any personal benefit. And since the insider had not breached their fiduciary duty because they weren't motivated by personal gain, the tippy, Dirks, could not be held liable either.
No breach by the tipper, no derivative breach by the tippee.
That's it. It's a critical distinction. It separates whistleblowing from self-dealing. But you can see the problem, right? Isn't that almost impossible to prove? If I tell my friend something purely as a favor or a gift, how can the SEC really prove my internal, intangible benefit?
Right. It makes enforcement way too subjective.
It absolutely did, and it led to decades of major confusion following the Dirks decision. Regulators really struggled to prove that intangible personal benefit when the tipper and tippy were just friends, not business associates exchanging cash.
So how did they resolve that?
Well, the issue was significantly clarified by a 2016 Supreme Court decision in Salman v. United States.
And how did Salman broaden the scope of personal benefit again?
Salman involved a man who traded on tips he got from his brother-in-law, who was an insider at an investment bank. Now, the brother-in-law gave the information to his own brother, who then passed it along to Salman.
A whole chain of tips.
Exactly. And the Supreme Court confirmed that giving a gift of a tip to a family member or a close friend is presumptively an act for the tipper's intangible personal benefit.
Ah, so it's assumed to be a benefit.
Right. This ruling essentially ensures that insiders cannot just hand information to their relatives or friends to benefit indirectly while avoiding liability themselves. The court recognized that giving someone the gift of a guaranteed profit is, in itself, a form of benefit to the tipper.
Okay, so the Tippy doctrine evolved to recognize the complexity of human relationships in these transactions. But even that didn't cover everyone. What about people who simply stole the information without ever having a direct relationship with the company whose stock they traded?
That's where the law took its biggest and most important leap. And this is what we call the misappropriation theory.
Misappropriation theory.
This theory doesn't focus on the duty owed to the company's shareholders. Instead, it looks at the duty owed to the source of the information, which is often an employer, or a consultant, or a law firm.
So using the company's confidential information is viewed not just as a breach of duty, but as literally stealing corporate property.
Precisely. This expansion was pioneered in cases like SEC versus Materia in 1984 and later affirmed by the Supreme Court in the landmark 1997 case, United States v. O'Hagan.
And what's the core legal concept there?
The core concept is that a person commits fraud when they misappropriate confidential information for securities trading purposes, and in doing so, they breach a duty owed to the source of the information. The fraud is committed against the principal, the employer or the source, not necessarily against the person on the other side of the stock trade.
So the O'Hagan ruling is profound because it explicitly recognized that a corporation's confidential information is its property.
That's the whole game changer. The undisclosed, self-serving use of this principal's property in breach of a duty of loyalty and confidentiality defrauds the principle of the exclusive use of that information. The court actually likened it to fraud akin to embezzlement. It's an elegant solution to catch people who skirt the traditional fiduciary duty rules.
Let's talk about that proofreader, Materia, because his case perfectly demonstrates the power of this theory. He wasn't a corporate insider in the traditional sense at all.
Not even close. Materia was an employee at a financial printing firm. He was proofreading confidential documents related to upcoming tender offers and corporate takeovers. He figured out the identities of the target companies just by reading the sensitive material as part of his job.
And then he traded on it.
And then he used that knowledge to trade. Now, critically, he owed no fiduciary duty whatsoever to the companies whose stock he was buying. His liability was based entirely on the fact that he stole the information from his employer, the printing firm, breaching his duty of trust to them. That theft and subsequent use constituted the necessary fraud.
So, to summarize this really complex legal landscape for you, the listener, in the U.S., you can be liable for insider trading if you violate a duty to the shareholders of the company. That's the traditional theory. Or if you violate a duty to the source of the information, even if that source isn't the company whose stock you're trading. And that's the misappropriation theory.
That is the perfect synthesis of the current American framework. And this brings us back to that extremely narrow line that still separates legal from illegal trading in the U.S. and similar non-European jurisdictions.
The famous overhearing the CEO scenario.
Yeah.
If I'm at a restaurant sitting next to a table where a CEO and CFO are having an unencrypted conversation about massive impending profits, and I buy the stock right away, I'm generally safe. Why does that happenstance acquisition of information not count?
Because you did not have a closer connection or duty of trust to the company or the officers, and you didn't steal the information. You were simply a random beneficiary of happenstance. The key is always the breach of duty.
Right.
Since the officers were arguably careless with the information, but you didn't violate a pre-existing trust relationship by using it, you haven't committed the necessary fraud required by U.S. law.
But if you had, say, pay the waiter to eavesdrop,
Then the situation would immediately change. Or if you were a close relative or a business partner, then duty or personal benefit might be inferred, and you'd be in serious trouble.
that emphasis on duty and fraud is really the defining characteristic of the U.S. system. But let's zoom out now and look at how the rest of the world handles this problem. And this journey takes us into Section 3, Global Frameworks and Judicial Nuance.
The U.S. model, because it's rooted in these 1930s anti-fraud statutes, is actually quite unique. The United Kingdom and the European Union, in contrast, operate under a much, much broader framework that's often categorized simply as market abuse.
Market abuse. What does that broader scope look like in practice, and how does it shift the burden of proof?
Well, under the UK's Criminal Justice Act of 1993 and the EU's Regulation 596/2014, it is illegal simply to trade on market-sensitive information that is not generally known.
So it's simpler.
Much simpler. The crucial distinction here is that you generally do not need to prove a specific relationship to the issuer of the security or to the tipster or a breach of fiduciary duty. If you trade on non-public, price-sensitive information, you've committed market abuse. End of story.
So in that European model, the person who overhears the CEO in the restaurant is in much greater jeopardy.
Oh, absolutely. The focus isn't on duty or theft to a principal. The focus is simply on protecting the overall integrity of the trading process itself.
And what about the intent?
Yeah.
In the U.S., you have to prove scienter, right? The intent to deceive.
Exactly, and that's another huge difference. In the European model, mere possession and use of the information is often enough to trigger civil or criminal penalties. This makes prosecution considerably simpler because they can just bypass all that complex litigation surrounding the personal benefit test from Dirks or the duty requirement from O'Hagan.
So despite these pretty big legal differences, there's a clear international consensus that insider trading is detrimental to global markets.
Absolutely. The International Organization of Securities Commissions, IOSCO, which regulates over 85% of the world's securities markets, explicitly lists protection from insider trading as a core principle for ensuring fair, efficient, and transparent markets. This isn't just a U.S. or European preoccupation, it's a global standard.
So organizations like the World Bank or the IMF would look for these rules when they assess a country's financial health.
They do. They often use these IOSCO core principles, which reinforces the global expectation that strong anti-insider trading laws exist and are actually being enforced, though it's worth noting that the severity of enforcement still varies wildly from country to country.
Let's turn back to the U.S. for a moment and look at the legal protections for legitimate insiders. If an executive knows major news is coming, but they have to sell shares for, personal financial planning, say, to diversify their huge holdings, how do they protect themselves from the assumption that they are using inside information?
That's the whole purpose of SEC Rule 10b-5-1. Since in the U.S., the mere possession of material non-public information is often enough for the SEC to infer that you used it when you traded, Rule 10b-5-1 provides what's called an affirmative defense.
An affirmative defense?
This defense protects the insider if they can demonstrate that the trade was executed as part of a pre-existing contract or a written binding plan.
So the key is that the plan must be set up at a time when they are clearly not in possession of any material non-public information.
Precisely. If I set up a written plan today that outlines automatic sales of 1,000 shares every single month for the next 2 years, and then a week later I learn explosive positive news that sends the stock soaring, those pre-planned sales are defensible.
Because the decision to sell was made before you had the information.
Exactly. The key is that the plan must be truly binding. It has to specify the price, the amount, and the date of the trades, and it must be entered into in good faith before the insider comes into possession of the material non-public information. It's a mechanism designed to shield routine mechanical sales from regulatory scrutiny.
That seems like a really necessary safety valve for executives who need to manage their wealth. But here's where the legal systems always hit friction. A tool designed for protection inevitably gets exploited for gain. We've seen significant conflict surrounding the alleged abuse of these 10b5-1 plans recently, haven't we?
Oh, here's where it gets really interesting, and it highlights how regulators have to constantly adapt. For years, there was this suspicion that executives were setting up these plans, waiting a very short period of time, and then quickly canceling or amending them based on subsequent inside information. The defense was being used offensively.
And this all came to a head in a recent case.
It was dramatically highlighted in the 2023 and 2024 case involving Taryn Praiser, the CEO and chairman of OnTrack, Inc.
So walk us through what the regulators alleged in that case. What was he doing?
Praiser was convicted of securities fraud. The Department of Justice and the SEC alleged that he sold $20 million of stock, avoiding $12 million in losses, by using purported 10b5-1 plans while he possessed negative non-public information.
So the fraud wasn't that he possessed the information and traded.
No, it was that he created the 10b5-1 plans fraudulently. The allegation was that he adopted these plans immediately after learning negative news about the company's biggest customer, and then used the plans as cover to sell before that bad news became public.
So he essentially tried to retroactively sanitize his trades by using the defense mechanism as a shield, but the timing just betrayed the entire purpose of the rule.
Exactly. The core of the fraud was the timing and the intent of setting up the plan itself. The court found that because he possessed that negative price-sensitive information when he established the plan was never made in good faith, and therefore it offered him no legal defense.
And that case sent a huge signal to corporate America.
A massive signal. Regulators are now actively scrutinizing the creation and adoption of these plans, not just the trades themselves, and this eventually led to the SEC implementing rule changes in 2022 and 2023, requiring mandatory cooling-off periods between adopting a plan and executing the first trade, specifically to close this exact loophole.
That's a powerful illustration of the legal system playing catch-up with corporate sophistication. Okay, so we've established that prohibition is the global standard, supported by strong legal mechanisms in both the U.S. and Europe. But we cannot have a deep dive on this without fully exploring Section 4, the radical argument for legalization.
This is a really robust academic discussion, and it's championed by influential scholars and economists who challenge the fundamental economic and philosophical premise of prohibition. We are talking about voices like Henry Mann, who wrote the seminal work on this, and the Nobel laureate Milton Friedman.
And their arguments run completely counter to that market fairness principle we've established. So what is their chief argument for repealing insider trading laws?
The primary argument is based on market efficiency. Friedman, in his own words, actually said, "You want more insider trading, not less."
Wow.
The claim is that trading based on material, non-public information benefits all investors generally by rapidly introducing new, accurate information into the market, thereby allowing the stock price to reflect the company's true value sooner.
So if the CEO knows the company is actually worth $100 per share, but the market price is only $80, the CEO's aggressive buying acts as a quick signal to the market, even if the trade itself isn't immediately publicized.
Right. The resulting price pressure itself contains information. The market sees a huge buy order and thinks someone knows something, and the price starts to adjust.
This rapid price discovery, the process of the stock price finding its true value, is beneficial to the broader economy.
That's the argument. If the information is hidden until a press release, then capital allocation decisions across the entire market are being made based on inaccurate, delayed information. Insider trading, in this view, is the fastest, most effective mechanism to ensure accurate price discovery, making the market more efficient overall.
Okay, another key philosophical argument put forth by these scholars is that insider trading is often a victimless crime. How on earth do they make that case when someone is clearly losing money on the other side of the trade?
They argue that it is simply an act where a willing buyer and a willing seller agree to trade property that the seller rightfully owns the shares. They contend that the investor selling the stock was already going to sell at that price, regardless of the insider's superior knowledge.
I'm not sure I follow that.
The idea is this. If I decide to sell my 100 shares of XYZ Corp at $50 today, I put that order in. An insider, knowing the price will soon be $60, buys my shares. The argument is that I was going to sell at $50 anyway. The insider didn't force me to sell or lie to me. So they believe the only true violation occurs if there is a breach of a pre-existing contractual duty or an outright lie, not just information asymmetry.
This sounds like a pure challenge to the entire concept of regulating information asymmetry, which, outside of corporate secrets, is often celebrated in business.
It leads directly to the geologist analogy, which is often cited to highlight the perceived inconsistency in the law.
Explain that analogy for the listener.
Sure. If a geologist, through hard work and private research, determines there is a high likelihood of discovering a major oil reserve under farmer Smith's undeveloped land, the geologist is legally entitled to make Smith an offer for that land and buy it without disclosing the geological data.
Right. That happens all the time.
The land is Smith's property, and the information is the geologist's private research. The law does not require the geologist to correct the farmer's ignorance about the land's true value.
So the proponents of legalization ask, if that's legal in land acquisition, why is it fraud in stock trading? And the answer, as we established earlier, comes back to that corporate fiduciary duty and the company's property rights to its own information, which just doesn't exist between the geologist and the farmer.
That is the regulatory answer. But the analogy really forces us to confront the consistency of the law when it comes to information asymmetry. And some advocates also make free speech arguments, suggesting that punishing someone for communicating accurate information about a company's financial status is an act of censorship, limiting the flow of vital information that the market needs.
Is there any form of middle ground proposed by these challenging scholars, something that might appease both the efficiency and the fairness camps?
There is a fascinating middle ground that's been suggested. Legalizing insider trading on negative information only. but keeping the prohibition on positive information.
Negative information only. Why?
The argument for this is pragmatic. Companies are naturally incentivized to release good news as quickly as possible, but they often withhold bad news for as long as possible, using every delay tactic available.
So allowing insiders to short the stock when they know bad news is coming would force the price to reflect reality much more quickly than waiting for a delayed corporate announcement.
It would act as a powerful, rapid correction mechanism. The proponents argue that negative information has a higher marginal value for market truthfulness than positive information, which will eventually come out anyway. It's an intellectual solution aimed at forcing transparency, where corporate incentives often resist it.
Now that we've established the legal and academic arguments, let's move into Section 5. High-stakes examples, corporate fraud, and Capitol Hill. These cases really illustrate the sheer scale of the profits and losses avoided, and how seriously the system takes this crime when the financial stakes are high.
These cases are critical because they put a human face on the breach of duty. Take the case of Matthew Martoma, a former portfolio manager at SAC Capital Advisors. He was accused of generating possibly the largest single insider trading transaction profit in history.
What were the numbers?
It was valued at an astonishing $276 million from insider information about a drug trial failure.
$276 million. That really puts the risk-reward calculation into stark perspective, doesn't it? The temptation must be overwhelming when those kinds of figures are on the table.
It is, and Martoma was convicted and sentenced to 9 years in prison, which reflects the severity of the financial harm and the fraud committed. Another high-profile example that demonstrated the corruption of duty at the very top was the case of Rajat Gupta.
Gupta was the former head of McKinsey & Co. and a director at Goldman Sachs.
Wow.
I mean, he was the epitome of the trusted insider.
He was, and he was convicted in 2012 for leaking confidential board information, including critical details about Goldman Sachs' financial results and a major investment from Berkshire Hathaway to the hedge fund manager Raj Rajarat.
A textbook violation of his duty as a director.
Absolutely. Rajaratnam was sentenced to 11 years and Gupta received 2 years in prison, proving that even the most well-connected corporate figures are not immune from prosecution when that fiduciary duty is breached.
We also have these almost anecdotal cases that show how creative and complex traders can be when they try to conceal their activity, making the investigation extremely difficult. The Billy Walters case is classic in this regard.
Billy Walters, a famous Las Vegas sports bettor, was convicted for making $40 million in profits and avoided losses in Dean Foods stock between 2008 and 2014. His source was a director at the company.
And how did they try to hide it?
To conceal their activity, they used prepaid burner cell phones and, most memorably, employed complex code words for the company in their communications, sometimes referring to Dean Foods as the Dallas Cowboys to evade detection.
The audacity of using such a recognizable code. That must have been a Herculean effort for the regulators to connect those dots and prove the connection between Dallas Cowboys references and specific stock trades.
It absolutely underscores the difficulty of modern financial crime investigation. They had to prove, beyond a reasonable doubt, that a message like, "I need 5 Cowboys by next Tuesday," was a clear instruction to buy stock in Dean Foods. The prosecution's success in connecting those subtle, concealed actions really demonstrated the resources the DOJ commits to building these complex fraud cases.
Now, beyond disgorgement, the courts sometimes use an additional, more unusual tool to punish insiders who violate their corporate trust. The faithless servant doctrine.
That was showcased in the Morgan Stanley v. Scowron case in 2013. David Scowron, a portfolio manager, engaged in insider trading, directly violating his employment contract and the firm's code of conduct. The court, applying New York's faithless servant doctrine, ordered him to repay his employer the full $31 million compensation he received during his period of faithlessness.
Wait, not just the profits he gained from the illegal trades, which he had to forfeit anyway, but his entire salary and bonuses earned while he was engaged in the misconduct. That goes far beyond typical financial penalties.
It's a punitive measure based on the concept that a servant and employee who is disloyal forfeits their right to compensation for the period of disloyalty. The judge in that case noted that Scowron's behavior damaged Morgan Stanley's reputation, which is a valuable corporate asset. Since he was paid to be loyal and he was disloyal, he had to give back what he was paid. It's an extremely aggressive and effective form of deterrence.
Now, let's turn to the highly sensitive area of political insider trading. Members of the U.S. Congress are clearly not exempt from insider trading laws. Yet they often seem to operate in a legal gray area that official corporate insiders do not enjoy.
This comes right back to the foundation of U.S. law. The need to prove a breach of fiduciary duty or a misappropriation of property. Members of Congress and their staff generally do not meet the legal definition of an insider because they typically lack a confidential or fiduciary relationship with the source of the information they receive, especially government information or the companies they oversee.
Well, the evidence of information asymmetry, the ability of politicians to profit from privileged knowledge, is hard to deny.
It is statistically significant. A famous 2004 study found that stock sales and purchases by U.S. senators over a sustained period outperformed the general market by a massive 12.3% per year. That suggests they clearly possess and act upon valuable information that the general public just does not have access to.
And we saw this play out in the clearest possible terms during the 2008 financial crisis, which was a real watershed moment for public awareness of this issue.
It certainly was. On the evening of September 18, 2008, Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke held a private closed-door meeting briefing members of Congress on the escalating financial crisis. They communicated that the situation was far, far worse than the public knew.
And what happened the next day?
The very next day, several lawmakers made highly timely trades or portfolio reallocations.
Can you give us some specific examples of those timely trades?
Representative Spencer Baucus, who was the ranking Republican on the House Financial Services Committee at the time, not only sold several investments, but actually shorted the stocks. He bet on them to fall the very next morning. He cashed in his profits within a week, just before the full market collapsed.
And he wasn't the only one.
No. Others, like Senator Dick Durbin and then House Speaker John Boehner, also made timely sales or shifted assets out of equities, effective the morning after that closed-door briefing. They possessed information that caused them to act, while the public remained completely in the dark.
The public outcry over this clear asymmetry eventually forced legislative action.
That's right. The public pressure led to the passage of the Stop Trading on Congressional Knowledge Act, or the STOCK Act, in 2012. This law explicitly affirmed that insider trading laws apply to members of Congress and federal employees. And crucially, it imposed new transparency requirements, forcing them to report stock trades publicly and promptly, usually within 45 days.
So the goal was to increase visibility and make it easier to identify suspicious activity.
That was the idea.
But even with the STOCK Act in place, the 2020 COVID-19 scandal became another stark reminder of the gap between what's ethical and what's, technically legal.
This occurred in February 2020. Several senators received confidential, closed-door briefings about the severe potential impact of the emerging COVID-19 threat, well before the administration publicly acknowledged the crisis's scale. Allegations quickly surfaced that these senators then sold large amounts of stock, particularly in sectors that would be hit hardest, like travel and hospitality, just before the market plummeted.
And the public reaction was one of immediate condemnation and outrage, and the Department of Justice launched a probe.
They did, which is important. However, here is the crucial legal complexity. While the information was critical and non-public, the DOJ ultimately closed its investigations into several of the senators without bringing any charges.
Why?
Because the information they possessed, sourced from government briefings, was not legally classified as corporate property, nor did the politicians have a specific fiduciary duty to the source of the government information in the same way a corporate director does to a company's shareholders. The lack of a clear legal mechanism for prosecution, even with strong ethical evidence, highlights the continuing loophole in the U.S. fraud-based system.
That distinction, the fact that critical non-public information held by politicians often doesn't trigger the legal definition of fraud, is a huge loophole that continues to erode public trust.
Absolutely. The STOCK Act increased transparency, which is progress, but it didn't fundamentally change the definition of fraud required to prosecute. The ethical duty is crystal clear, but the legal duty, as interpreted by the courts, is much, much harder to apply in the political realm.
Okay, let's move to our final section: modern threats and global reactions. The digital age has unfortunately made the commodification and distribution of non-public information easier than ever, creating brand new avenues for insider trading.
The primary modern threat is the dark web market. A 2016 report revealed that sophisticated dark websites were operating specifically as marketplaces to sell non-public, commercially sensitive information.
And these are hard to trace, I assume.
Extremely. They often use cryptocurrencies like Bitcoin to facilitate anonymous transactions and circumvent traditional currency restrictions.
And this information isn't confined to being used just for stock trading anymore.
That's the scary part. That confidential data, maybe a company's proprietary algorithm or details about a regulator's upcoming ruling, can be used for purposes far beyond securities trading. Think corporate espionage, gaining a competitive edge in contract bids, or even assisting in acts of corporate sabotage. The criminal utility of stolen confidential information has expanded significantly beyond just making a quick buck in the stock market.
So let's look at some international enforcement examples to show the varied responses globally. This illustrates that while the law exists pretty much everywhere, the severity of the response differs.
We can start with Brazil, a major emerging market economy. Brazil's law clearly defines the conduct as misuse of privileged information. However, despite the law being in place since 2001, the country's first criminal conviction for this didn't occur until 2011 in the Sadia Perdigão merger case.
And that case was significant.
It was. It resulted in fines and, importantly, the inability of the convicted individuals to serve on public company boards.
Meanwhile, Canada delivered one of the longest sentences in the world for an insider trading scheme.
Yes, in 2009, a Canadian lawyer named Stan Gromofsek pleaded guilty to a conspiracy that spanned 14 years and generated over $10 million in illegal profits. He received a 39-month prison sentence, which was, at the time, the longest term ever imposed for insider trading in Canadian history. It signaled a clear shift toward harsher enforcement, mirroring the U.S. approach.
India presents a more frustrating regulatory environment where insider trading is widely believed to be rampant, but prosecution remains incredibly difficult.
The challenge in India is often procedural. Despite the widespread belief that insider trading takes place regularly, cases can take over a decade to reach a resolution. Enforcement is slow, and historically the punishments have been relatively light. While SEBI, the regulator, has the power to demand substantial financial penalties, the fines levied have often been viewed as minimal, especially when compared to the potential profits. This slow-moving system really undermines the deterrence factor.
And finally, China is a good example of regulatory inconsistency. Historically lax, but capable of massive crackdowns.
Before the country's major financial reforms in the mid-2000s, punishment was generally rare and often just limited to monetary fees. However, as China's financial markets matured, the state has demonstrated its capacity for severe sentences. In a high-profile crackdown in 2017, the major fund manager Xu Zhang was sentenced to 5.5 years in prison and fined an enormous 11 billion yuan.
That's one of the largest financial penalties ever imposed.
It is, and it illustrates that while regulatory enforcement can be inconsistent, Chinese authorities are certainly capable of imposing brutal sentences to maintain control and signal state authority.
So, after all that, what does this all mean for you, the informed investor and observer? We've navigated the global commitment to prohibition, which is driven by the absolute need for fair markets and corporate integrity. We've also seen the U.S. legal framework constantly having to evolve, moving from a strict fiduciary duty model to the sprawling misappropriation theory just to catch the cleverest criminals.
I think the key takeaway is that understanding insider trading isn't just about reading headlines of corporate malfeasance. It is about appreciating this complex web of duty of corporate property rights and the legislative attempts to keep pace with information asymmetry in a global, rapidly evolving market. The core tension remains fundamental. How do you foster public trust and enforce fairness without suffocating the flow of valuable, price-correcting information that is vital for market efficiency?
I think we have to end with a question that connects the corporate and political spheres, particularly given the U.S. adoption of the misappropriation theory. The idea that a company's non-public information is its property to be protected from theft.
That property theory is what makes the final question so relevant. There was the notable case of United States v. Blasak, where the so-called king of political intelligence was convicted for trading on confidential government regulatory information that was stolen from the Centers for Medicare and Medicaid Services. The law actually extended the misappropriation theory to protect government data, treating it similarly to corporate property.
Which raises a really important question for you, the listener, especially in light of the 2020 scandals involving Congress. If the U.S. law views the theft and trading of confidential corporate secrets as fraud akin to embezzlement, should the theft and trading of confidential government regulatory information, which clearly affects markets, be viewed as equally harmful?
And what ethical duty do politicians and their sources owe to the market when they receive non-public, price-sensitive information? And how far should the law go to enforce this duty, even when the information isn't a traditional corporate secret, but a public one just waiting to be announced? It's a question of whether the legal duty is strictly to the company or if the duty now must extend to the integrity of the market itself. As information continues to be the most valuable and volatile commodity in the world, that answer will define the future of securities law.